The 2022 model is probably the most used and traded ICT model that he ever created, and yet so many people just continue to fail with it, and it is simply because you have no idea what you're looking at. So a typical 2022 model would be a predefined high, some sort of significant liquidity sweep that we take out. We make a market structure shift, then we get the retracement into the fair value gap that we created, and then a rally down to the next liquidity pool. That would be a typical ICT 2022 model. Yeah. So obviously, this being the buy side liquidity sweep, this being the market structure shift, and then some sort of inefficiency right here. And then this right here will be your entry. That is a typical ICT 2022 model, and it has such a bad win rate for many different reasons, and that is exactly what we're going over in this video. So the first thing is people have no idea when to trade and when not to trade. So let's quickly go over exactly when you should be trading and when you should avoid trading. So if we take a look at this specific day, we go to Forex Factory. That is my go-to news website for economic news, of course. What we want to pay attention to here is the news on Mondays. Okay, so when we have Mondays with no red news folder, obviously I am referring to USD based pairs since I'm only trading the Nasdaq and the S&P. So whenever I have a Monday with no red news USD folder, that is a day that must be avoided at all costs. Okay, you want to engage in markets with volatility, and Mondays are just known for a lack in volatility and lower probability setups. And when that is combined with no news, there's simply not enough volatility for you to get involved. And even if there is some volatility, the setups that are going to appear are likely going to be lower probability, and you are going to get some unnecessary losers that you will question. As you probably know, news is what drives the market. So when there is no news, there is just simply not enough volatility for you to get involved. So Mondays with no news is a straight no-go, and even days with no red news folders, regular days, Tuesday, Wednesday, whatever it might be, with no red news is going to be lower probability. Now, speaking of the economic calendar, what you want to be avoiding is also FOMC mornings. The morning before FOMC or prior to the FOMC being released is always going to be choppy. I always avoid FOMC mornings, and if I trade on FOMC day, I only trade PM session, because PM session is where we have volatility. And again, if there's no volatility, I simply do not want to trade. Then you do not want to be trading the days prior to the big news. So that is again CPI, FOMC, unemployment claims, all these bigger news events. The day prior to them are always going to be lower volatility, because the market is waiting for those big players to step in and all that volume to be pushed into the markets with the news the following day. So days prior to very big news events are always going to be less fortunate. Now, while I do still trade them, they do offer lower volatility. Then we have the day prior and the day after bank holidays is also something that you want to be avoiding, just because of, again, a lack in volatility and lower probability setups. Now that we're done with the economic calendar, I want to talk about the overnight session. Okay, so if we take a look at Asia session here, you can see this was today. You can see that Asia made quite a massive move, and it obviously trended to the upside. Okay, when Asia makes a large move, typically anything above 30 handles, I personally avoid. And when it also trends in a certain direction. Okay, when the overnight session or Asia session trends either bullish or bearish and does not consolidate, the New York AM session is going to be lower volatility, lower probability, and just overall bad price action. So today, for example, we had a huge overnight move, so I avoided New York AM session completely. And if I want to trade, I wait till PM. This is something that not a lot of people talk about. We have a look at London, which obviously made huge moves too. So today was simply just a no trade day for me in terms of the AM session. So that is the reason why a lot of people fail with any model from a fundamental point of view. Now let's get into the technical point of view of the 2022 model and what you can do better. So with the 2022 model, the narrative is extremely important. The overall drawn liquidity or the higher time frame drawn liquidity is going to be the most important thing. Getting the drawn liquidity right is the only way you're going to be able to tell which highs are going to send us lower and which lows are going to send us higher. And that is obviously exactly what you are predicting with the 2022 model. So without the higher time frame drawn liquidity, you simply will not profit with the ICT 2022 model, because in that case, that will be a mechanical strategy, and none of ICT strategies are mechanical. It all comes down to the narrative. So the number one way to increase your win rate with the ICT 2022 model is to look for SMT divergences. The best 2022 model setups appears with an SMT divergence, and I in fact would probably not even consider taking a 2022 model setup if there was no SMT divergence present. So let me show you this great example right here. We will just quickly go back here, and then we can see we obviously swept this high here. But with this high being swept came an SMT divergence with ES, meaning that the NASDAQ swept the high, the S&P 500 did not, okay? But again, the narrative comes into play. The overall drawn liquidity is going to be the most important factor when it comes to profiting off of the 2022 model, because without knowing the drawn liquidity, you have no idea. Because without knowing the drawn liquidity, you have no way of telling which highs are going to work and which lows are going to work. So again, we have an SMT divergence here. Now what I want to do is go to a lower time frame, like the 2-minute time frame, and then I want to pay attention to a market structure shift. But with that market structure shift must come the violation of a fair value gap. That is very important. That is something you want to pay attention to. So in this case, we obviously have a lot of fair value gaps here, but I am just going to go with the first one that also creates a market structure shift. That will be this smaller imbalance here. If a candle closes below this 2-minute imbalance here, that would mean we violated a bullish gap while creating a bearish market structure shift. But again, look at the narrative. What sent price all the way up here was this sudden bullish movement, the 9:30 opening bell, okay? I have said this countless of times in previous videos. 9:30 is a Judah swing 90% of the time. So wherever the 9:30 opening bell sends us, I will typically look for a trade in the opposite direction once it sweeps liquidity. I say this over and over again, and so many people get screwed by it, because if you take a look at this, it obviously comes with a lot of bullish displacement and it looks very bullish. But when you look at the time and you see that 9:30 is what sent us there, it's likely manipulation and we are going to go lower. When that is combined with an SMT divergence like this is exactly when I look for a 2022 model and really not anywhere else. The problem with a lot of people is that they take any higher time frame high and then they try to find a 2022 model off of that high, and that's simply just not enough. So what do we have here? We have my higher time frame drawn liquidity for this day, which was yesterday, being lower. We have a 9:30 Judah swing, and then we have an SMT divergence at the high, right? So only now will I look for my short. So at this moment, I am just waiting for a fair value gap to form, and then I will take that. Now again, this is where a lot of people will screw up. They see this bigger fair value gap being formed, and then they instantly take this short instead of waiting. Of course, it is because they are scared of missing the move that they have waited this time for. But I promise you, when you have such a big fair value gap that came with such displacement, and the candle after this displacement candle is sort of an indecisive candle, you do not want to be shorting this gap, at least not from the beginning of it. If I were to short this gap, it would have to be of the continuous encroachment because of the size of it. And now let me show you something, a little secret here to figure out where inside of whatever gap you're looking at to enter, okay? So as I just said, I would want to enter somewhere around the continuous encroachment of this gap, because when it is this big, I'm simply just not comfortable with placing my entry at the beginning of it. So I will go to a higher time frame like the 5-minute and look for a gap there. As you can see, the continuous encroachment of the 2-minute gap aligns very well with the beginning of the 5-minute gap. We take a look even further. We have an order block that overlaps with this gap, right? So this is exactly when I would look for my entry. I would put my stop a bit above the 5-minute imbalance, not expecting it to go higher, and targeting the opposing liquidity, right? Before we press play, let's go over exactly what happened again. 930 Judah swing, SMT at the highs. This is the most important step. SMT at the highs, consolidation after the SMT. We did not continue to displace above the highs after we formed the SMT. Very important. Then we consolidate for a while. When this huge displacement candle to the downside happens, automatically and instantly making the previous candle an order block, that is when I start looking for shorts. Then I just want to wait until I see a fair value gap form. Now, obviously, that came on in this leg and not this leg, unfortunately. So the entry will not be as good on a 2-minute time frame. Maybe there was one on the 1 minute, but since I am on a 2-minute time frame, this right here is where I would enter. Exactly where I would enter. Now I do have the higher 2-minute gap included in my stop, which is exactly what I want. If we take out the premium discount tool for this small range here, or of this leg, we can see that we are right around equilibrium 2, which is exactly what we want. If we go to a 4-minute time frame, we can see that this is obviously a bearish unicorn model that also overlaps with our entry. So as you can see, I'm getting a lot of confluences here, but the things I want you guys to pay attention to, and this right here is really why people are not succeeding. They're not watching for an SMT. They're not looking at the gaps out here that we are violating, and they're not taking the higher time frame drawn liquidity into consideration. So again, we're violating all of these bullish imbalances after creating that SMT divergence, which is exactly what I want to look for. I do not care that much about a market structure shift. What I care about is whether we are violating bullish PD arrays or not. Because if we start violating bullish PD arrays right after we formed an SMT divergence, sweeping some highs, I know that the bearish PD arrays should hold. So let's play the trade out. And as you can see, it just really could not get any more beautiful than this. And again, this right here is exactly why people fail. Almost no ICT 2022 model traders would have even considered turtle swooping this high. They would have probably waited for this high or even this high, right? At least a more significant high than this internal high. Most of the time, people are trading the 2022 model off of external liquidity, when really you want to be doing it off of internal liquidity with SMT divergences, in my opinion, exactly that we did here. So in this case, this would be the external high. This is an internal high. And so when we have an SMT divergence here, that is exactly when we look for a trade. We do not care that much about the market structure shift. We care about whether we are holding the bullish PD arrays or not. So the only good part about getting such a late entry is that we were able to see price violate bullish gaps, right? And at the same time, holding the bearish ones, because obviously we had a bearish order block here that price respected very nicely, right? So SMT divergence, we're starting to violate bullish gaps and hold bearish ones. Therefore, we have no reason to believe that this bearish gap should not hold. And again, when the gap is this big, I am waiting for a retracement back to at least the constant encroachment of it. And if that doesn't happen, I simply missed the move, and that's it. And that was it for this video. This is, in my opinion, why people are unprofitable with the 2022 model. They simply do not know what to look for, and they are trading it mechanically. It is not a pattern, okay? You cannot just be selling every fair value gap that you see form after a high gets taken out. You must have more information, and that information comes from SMT divergences, inversion fair value gaps, and displacement. Those are the 3 things you need to look for when trading the 2022 model. Not just sell every fair value gap after a high gets taken out and buy every fair value gap after a low gets taken out. That is why people are failing. So I hope you enjoyed. Try it out. Let me know what you think. Don't forget to join the free Discord in the description, where I post daily outlooks and weekly outlooks. Take care.